Good evening, traders. This will be a market review for the price action for Monday, 23rd of October. In front of us, we have the mini S&P. We'll be starting with this market. We've seen a run below these lows, just as anticipated in the weekly market review video. I anticipated a run on this sell side while leaving this fair value gap open. We didn't get enough steam to run below these equal lows. However, we've seen a vault from the sell side liquidity, external range liquidity, and it's safe to say we can seek this volume imbalance. That noted. That's a volume imbalance in the daily chart, and you can see the market seek this. We had the volume imbalance right there. And we're going into Tuesday. I still expect we are going to maybe run on this low and probably up to consequent encroachment of Monday's trading range before challenging this fair value gap or this daily volume imbalance. Mini S&P 4-hour chart. See that the daily volume imbalance. See nothing on the 4-hour chart, but we have a CB on the 4-hour time frame. See the run below sell side today in the London open Q zone, then the rejection in the New York open. We open up on Monday, nearly around the daily open, and right after London opening, we cascade lower below sell side. Then we started rallying off the lows. Going into 9:30, we are looking for PDRAs inside the London price range and the previous day PM session and AM session price ranges. In this case, in this scenario, we are traded below the daily PDRA, which is an old low. An active daily PDRA is the daily time frame. In this scenario, the daily time frame sell side liquidity is active, and time has met price. We have seen a willingness to move away from it in the overlap between London open and New York open Q zone. The Judah swing at 8:30 or 9:30 CME open had us see a run below the London session lows, and this is a classic ICT 2020 model, or I think 2022 model, ICT 2022 model, where we run on the sell side. Any liquidity pool prior to 8:30, we run on that with a shifting market structure, then a delivery to a higher time frame PDRA, fair value gap, or a liquidity pool, which we have on right here. buy side, and the buy side above Friday highs, which wouldn't really trade to 15-minute time frame. See the opening, trade down, the run on liquidity on the CME opening, then it move higher that it should. Then you can see a fair value gap entry, a rebalance, or a redelivery, preferably a redelivery into a previous fair value gap, then a run higher into buy side liquidity and this rejection block from Friday PM session. Five-minute chart, that's the run on sell side, low, high, lower low, that's a breaker. That's a breaker on the 5-minute chart. See a return to it at 10:30. $10.50 to 11.10. That's a macro. Two down close candles into a breaker. This can be classified as a bullish order block. Then we trade back into that on the 10:55 candle, and off to the races we went. Above buy side, a little consolidation using the 60-minute fair value gap as inversion to run it higher into the rejection block from Friday's PM session. 1-minute chart. There is a shift in market structure. That's a shift in market structure. That's a breakaway gap. There's a fair value gap at the 950 to 1010 opening price. One thing I've discovered from backtesting old price data, when there's a shift in market structure after the 930 Judas swing, not all fair value gaps will be filled, and at times the macros, that is the macros, the index AM session macros, they help you determine what PDR is or fair value gap won't be traded or be delivered to. In this case, we have a fair value gap lower here and another one will be down here. If this market is really bullish and it's wanted to run to a premium pricing, should it come back down here, will it be ideal? No, it won't be ideal for it to run down to this price level. So it makes sense for it to reject lower pricing and want to run higher. Then we have the breakout on the 5 minutes, low, high, lower, low. Inside this price range is where you'll be actually looking at for your PDRs to go long. So inside this price range, breakout low to high is the range you'll be looking for PDRs to go long in sync with the daily range, with the direction of the daily range. So 9:50 early AM as the first AM session macro, 9:50 to 10 past 10. If we look back, 9:30 we have done the damage. We ran on sell side liquidity from London session. Everyone that's been buying the lows, seeing the rejection, willing to hold for a higher close on the day, they've all been stopped out. So we're actually looking inside this range for PDRs to facilitate longs. Keeping in mind that this market is really bullish. If time has met price and we are below sell side external range liquidity, and we should reach for internal range liquidity targets, then this market should not really deliver to this fair value gap or even this fair value gap, because we are within breaker block. It's not necessary. So there we go, 950 right there. We're trading inside a fair value gap within a breaker. That would be a hypothetical buy position with a stop loss at, for people with low risk tolerance, you can put your stop loss right at this candle's high at 42.21. For people with a higher risk tolerance, you can set it at consequent encroachment of this breakaway gap. First target is your 60-minute CB. Then the final target will be rejection block on Friday's high. Dollar index, this one is really interesting. Really interesting market we just had today. $20-day EBITDA data range from Friday's closing price. You have buy side in here. Buy side have run out. What other PDRs exist in here? We really call this a breaker. Okay, I guess this in a way we can call it a breaker. Anyways, I'd call it a breaker. So we also have the consequent encroachment of this candle's wick, and if you get into this small little fair value gap up here. So the consequent encroachment of this candle's wick, we've been respecting that, showing willingness not to want to go higher, and we've also been respecting this fair value gap on the low end. In the weekly review video, I said, should we hold this fair value gap, then we would watch if he wants to run the buy side, and if he does run this buy side, I will be expecting the highs of October to be tagged. And if that's not the case and we lose this fair value gap, I will look for it to act as an inversion fair value gap to send us into this sell side liquidity. And I held the opinion that I don't think this sell side liquidity is likely unless we start getting really wild and erratic on price action, and that will be it. And that is more likely to be caused by maybe this wartime saga or the economic calendar, the economic events. The closest economic events that may be really impactful, I think they're just 2 weeks away. So expecting a run on this liquidity, I'm not really expecting that. So we have tagged sell side. Let's go on to the lower time frame, 4-hour chart. Sunday opens up close candle into the high of the fair value gap, premium high of the daily fair value gap, We break down. London open, we trade back up into the up close candle, reject it. New York open, trades back up into the up close candle, and we give up the ghost, running into sell side liquidity. Quite straightforward. Here we are. This is the high and low of the daily. You see, change the colors. High of the daily fair value gap, low daily fair value gap. In the weekly market review video, I said, should we lose the lows of the fair value gap, then I'll be looking for a run on the sell side. If we look on the 15-minute time frame, I think that's close. 5 minutes. We saw a run up early 2 a.m. then a breakdown. Classic ICT 2022 model. After running above London close buy side liquidity from Friday, that's the classic ICT 2022 price action model right there. Then we cascade lower. We ended around prior to the New York opening. Run below this short-term liquidity, engineering equal lows for retail to buy, because this market has been bullish for the past few months. If retail say this, well, come on, it's going to keep going higher, so they think. So double bottom, we break above this short-term high, retail see that as buy resistance turn support, willing to buy it long and take profits at higher prices, but the algo runs it above an old high from the previous session and into a PD array inside the previous session, which is this CB right there. Right there at the 940 candle, then it displays lower, running into sell side, and you can see here we don't even revisit the low of the discount low of the daily fair value gap. Well, but we do offer a fair value gap right entry right there. Institutional order flow entry drill, basically, then cascaded lower into the sell side. Had I been in front of the charts right after we lose this daily fair value gap, and I say that we didn't have a willingness to return back up there, like when the market was right here inside this price trading range, and the SMT between the dollar index and the British pound markets was present, I would go short on euro dollar or British pound US dollar, depending on which is the. I will go long on euro dollar or British pound US dollar, depending on which is the strongest or which is the leader. Here we go. Higher lows on the British pound US dollar, lower lows on euro US dollar, and we can see British pound US dollar was more parabolic. Euro dollar stay at the stellar delivery anyways. One minute chart. There has to be something that used the low of the. There's still nothing. This market was really bearish and it was unwilling to return to the low of the daily fair value gap. I think that will be all for now. Is there really any need for us to cover the euro dollar since we've covered the dollar index? We've run above the buy side and we use this daily fair value gap as inversion, just the way I brought to your attention on the weekly market review video. Active PDRA daily inversion fair value gap. We move away from it in the London session. We reprice to a London session fair value gap post New York open. We have a down close candle that is a order block. We can qualify this as an order block, and you can see the bodies of the candle respect it. We have wicks below it, but we could care less because we also have a fair value gap down here. New York open Q zone reprices down into the fair value gap and into this order block, then off to the races we went, just as anticipated. And if you extend this, you can see the bodies of these candles were also respecting this CB on the weekly time frame, so you could also use that as an inversion to look for buying opportunities, send you up into buy side. After numerous attempts to run the highs in here, we are finally seeing British pound run up there, and it's nothing new. We knew that we had no bias, but we had our attention on the buy stops pulling above these highs. It's all in the weekly review video, and you can go and watch that before watching this. So going into the new day, I would expect this to continue, but I really don't want to be holding any hardline bias on currency markets right now. So soft bias going into tomorrow, we want to see a continuation into the daily CB and maybe this old high. That will mean we would eat into this daily fair value gap significantly, then see if we want to use it as support to run higher if we do slow down inside this price range. Should we start coming down all the way below consequent encroachment of this Monday's candle, I won't be really bullish on British pound dollar anymore. Euro dollar, same thing. If you're reaching for this, then should we overtake this, then we can wait for the buy side above here, above 20th of September's high. That'll be all. Good luck and good trading.